David Burrows from Barometer is here. We're talking North American large cap stocks at 1-855-326-6266 and market call at bnn.ca is the email address. William's written into you from Winnipeg. He asks Morgan Stanley. He wants your opinion.
Okay. So for those who have watched, we've been bullish U.S. equity since February of 16, so it's about 18 months. We continue to be very bullish. In the spring of last year, financials started to relatively outperform. They had a little rest over the winter this winter and consolidated and had a very strong run up into earnings. So Morgan Stanley is one of the banks that we own. We like it for a number of reasons. One, they're the #1 institutional equities trader. So with stronger equity markets in general, that'll be positive for them. They're very strong on the wealth management side, #2 on the wealth management side. Private investors are engaged, and it's pretty levered to the U.S. economy. So we do think long-term rates slowly go higher, not in any hurry, but that's positive for them and the other U.S. banks. And so I think we can get really good dividend growth, some good capital appreciation, and really the stock has consolidated over the last number of months. So historically, the U.S. banks run up into the earnings. They tend to back off a little bit on the earnings reports, and then in the 30 days that follow, they reestablish strength. So I think it's actually a great time to be buying them right after the earnings reports.
1.76% dividend yield right now. When do we get another increase?
Well, they're gonna raise the dividend, dramatically because of course they're able to pay out over 100% of their earnings. So we think that they can continue to grow the dividend north of 25%.
Thank you very much for the email, William. We're going to go from Winnipeg in the mailbox to Vancouver. Jerry, good morning to you.
Good morning, gentlemen. David, can you give me your view on the American banks like Bank of America versus the life cos, American life cos like Prudential? Would you be a buyer of one or the other, or would you wait for a pullback on these to come?
Well, Jerry, the people are going to think this is a plant because we actually own both Prudential and Bank of America. And so we own them for slightly different reasons. Obviously, Prudential, the life cos are big beneficiary of rising rates, has a big impact on them, as do the U.S. banks. We think that you're going to see improving loan growth in the U.S. For Bank of America, and if you look at the charge-offs for credit coming in very benign, so. Bank of America, you get a number of different revenue streams. You get wealth management, you get capital markets, you get U.S. loan growth. Both are very domestically focused. Bank of America, 75% of their revenues come out of the U.S., and we like the U.S. domestic economy. So frankly, I would buy one, the other, or both for both dividend growth and capital appreciation.
In the financial services space in the U.S., with that in mind, then, if you were to buy more than one, what kind of weighting would you ascribe to a model portfolio? Knowing you don't know Jerry's specific situation, would you equal weight or overweight?
One of the nice things about this market that we're in is I think you can own the life cos. I think you can own the U.S. large banks and regional banks. And I also think you can own financial technology companies like Visa and PayPal and really cover the waterfront. All four are being driven by slightly different things. But to put a point on it, the U.S. banks are trading at 1 times book value. And they've traded at 3 to 4 times book value in the past. So you get this slow uptick in rates, and a decent consumer, a decent loan growth area. I think you could probably weight them 25% in each. So 25% Lifeco, 25% big bank, 25% regional bank, where there's going to be consolidation, and 25% fintech for your financials weight.
Right.
Okay. And I would do that at the expense of Canadian financials, especially given the run-up in the Canadian dollar in the last couple of months. I would take advantage of that. Buy U.S. dollars here. I think it's highly unlikely Canadian dollar stays where it is.
There you go, Jerry. Thanks for the call from Vancouver. Natalie in Toronto, hello.
Hi, thanks so much for taking my call, Mr. Burrows. A couple of weeks ago when you were on, I consulted you on a stock named NVIDIA, and you recommended I purchase it. My analyst strongly recommended not to buy it, and I listened to him, unfortunately. I noticed that it's gone up by $20 in the last week or so, and I'd like still to have your input. Should I purchase it still for a long-term hold, or would you go elsewhere? So I'd very much appreciate your opinion. Thank you so much.
So Natalie, NVIDIA is dead center of a couple of really key long-term themes, right? So they produce GPUs, processing units, that are used for highly intensive computing power for things like artificial intelligence and machine learning, autonomous driving, augmented reality, and these are all things that are early days.
Used to be just the GPUs were for my video games.
Yeah, that's right. That's right. Back to the ATI days.
Yeah.
So, look, there's some very long legs to this theme. You know, Barometer is all about identifying key secular long-term themes and focusing in those areas and trying not to get shaken out. So the thing you need to remember is that in the technology space, 40% of the returns each year come during the earnings period. So, you know, you saw what happened in Netflix yesterday, right? They report the number, they beat and exceed, shares get a good lift. So I think that you can own this stock. We own it. I would buy it here. I know it's expensive, right? And so you have to pick your point at which you might, you know, use a stop loss. You know, so understanding that it's a higher volatility position, I think that the long term is very, very attractive for NVIDIA, and we like the semiconductor space as one of the core themes.
Quick discussion on strategy here. I'm looking at the relative strength index. It's in overbought territory now. It oscillates up and down on that.
Yeah.
Should we be talking to Natalie about buying the stock on the down leg of the uptrend instead of now at the top?
So, for instance, the 50-day moving average is a little below $150.
Yeah.
Right.
145.19.
And it's pulled back a number of times to the 50-day and just below. It certainly could pull back, you know, to 140. The problem is I don't know that that is what's going to happen here. Earnings are 22 days away. If we like the company, you want to own it into the earnings, even though there's risk associated with that. I think that if you look at what's happened to this stock in each of the last 3 earnings periods, it's gapped higher coming out of earnings. So this is one I would be inclined to buy now as opposed to later.
Thank you, Natalie, for joining us from Toronto. Brief break for David Burrows, President and Chief Investment Strategist at Barometer Capital Management. We're talking about North American large caps. We do have a line open. You can call toll-free 1-855-326-6266. I'm Michael Hainsworth in for Andrew Bell. Market Call returns in a moment.